Is AI a bubble? A contrarian view on the future of AI investments. Hello, fellow boomers. Welcome back to our channel. On the brink of 2026, the whispers are growing louder. From Silicon Valley boardrooms to Wall Street trading floors, a single question echoes. Are we witnessing the next great tech bubble? Is artificial intelligence the tulip mania of the 21st century, destined to wilt and collapse, leaving devastated investors in its wake? The answer might surprise you. But before we dismiss the bubble warnings entirely, there's something the skeptics are missing: a fundamental shift in how value is created in the AI economy. And understanding this shift might be the difference between making the investment decision of a lifetime and sitting on the sidelines while the world transforms around you. Stay with me, because what I'm about to reveal challenges everything you've heard about tech bubbles. Quick favor: if you're finding this analysis valuable, give this video a like. It pushes this contrarian perspective to more people who need to hear it. And if you haven't subscribed yet, hit that subscribe button now. We're publishing weekly deep dives on AI, technology, and markets that cut through the mainstream narratives. Also, drop a comment below right now. Tell me, do you think AI is a bubble or a revolution? We read every comment, and your perspective matters. Now let's get into why this time really is different. The bubble narrative takes hold. Scroll through LinkedIn or X for just a few minutes, and you'll encounter a familiar refrain. Industry veterans and armchair analysts alike are drawing ominous parallels to the dot-com crash of 2000. They point to soaring valuations, frenzied investment, and astronomical spending on AI infrastructure. The comparisons seem almost too obvious to ignore: inflated expectations, speculative fever, money pouring into startups with grand promises but uncertain futures. The skeptics have a point. Companies are indeed investing hundreds of billions of dollars into AI technologies. Tech giants are racing to dominate the landscape. Stock prices have surged, and history has taught us a painful lesson. When everyone believes something is the future, when investment outpaces actual value creation, disaster often follows. But here's where the conventional wisdom breaks down. The AI revolution isn't following the script of previous bubbles. In fact, the structural foundations beneath today's AI investments are fundamentally different from anything we've seen before. Why this time really is different. During the dot-com era, hundreds of companies burned through cash with little more than a website and a dream. They had no clear path to profitability, no sustainable business models. They were building castles in the air. Today's AI leaders operate on entirely different terrain. Companies like Google, Microsoft, and Amazon aren't gambling on vague promises. They're generating massive cash flows, real money, real profits. Their price-to-earnings ratios, while elevated, are backed by solid earnings, not speculation. These aren't garage startups hoping to figure out revenue later. They're established giants with proven business models, now supercharged by AI capabilities. This distinction is crucial. When companies with billions in annual revenue and established customer bases invest in AI, they're not speculating. They're strategically positioning themselves for the next phase of technological evolution. Let's talk about the elephant in the room: the staggering amounts being spent on AI infrastructure. Estimates suggest annual investments could reach hundreds of billions of dollars in the coming years. Critics see waste, but look closer, and you'll see strategy. Companies are leveraging debt, not out of desperation, but as a calculated financial maneuver. Why? Because the anticipated returns from generative AI are substantial and measurable. These aren't blind bets. Businesses are seeing tangible results: increased efficiency, automation of complex tasks, new revenue streams. The spending is tied directly to revenue generation. For every dollar invested in AI infrastructure, companies are projecting significant returns. This isn't throwing money at a problem and hoping something sticks. It's sophisticated capital allocation based on demonstrated results. To truly grasp where we are with AI, we need to zoom out and look at history. Economist Carlota Perez developed a framework that explains how technological revolutions unfold in two distinct phases: installation and deployment. The installation phase is messy. It's about building infrastructure, working out the kinks, figuring out what actually works. Then comes deployment, when the technology becomes integrated into everyday life, when its true transformative power is realized. By most expert accounts, we're standing at the threshold of AI's deployment phase. The infrastructure has been built, the algorithms have been refined, the use cases have been proven. Now comes the widespread adoption that will reshape industries from healthcare to finance, from education to manufacturing. Compare this to previous technological revolutions. Steam power took decades to fully integrate into society. Electricity required massive infrastructure investment before it became ubiquitous. Computers followed a similarly gradual adoption curve, but AI's adoption cycle is notably shorter. Why? Because the infrastructure was already in place. 2 decades of investment in data analytics, cloud computing, and machine learning created a foundation ready to support AI integration. Companies have the data, the computational power, and the skilled workforce needed to deploy AI solutions rapidly. There's a concept in technology adoption called the hype cycle, and it's brutally honest about how innovations progress. It starts with an innovation trigger, rockets to a peak of inflated expectations, crashes into a trough of disillusionment, then climbs the slope of enlightenment before reaching a plateau of productivity. Where is AI right now? We're in that trough of disillusionment. The initial euphoria has faded. People are asking tough questions. Some early promises haven't materialized. This is actually a healthy sign. Here's the critical insight. The trough of disillusionment doesn't mean a bubble is about to burst. It means we're moving past speculative hype toward practical application. Companies are no longer chasing AI for AI's sake. They're integrating it where it delivers real value. This recalibration is precisely what separates sustainable technological revolutions from speculative bubbles. In the 1980s, economist Robert Solow made a famous observation. You can see the computer age everywhere, but in the productivity statistics. This phenomenon, now called the Solow Paradox, reveals something crucial about technological transitions. New technologies don't immediately boost productivity. In fact, they often cause temporary declines. Why? Because organizations face substantial upfront costs: implementation, training, workflow redesign, infrastructure upgrades. Employees need time to learn new tools. Processes need to be reimagined. These transitions are messy and expensive. But here's the thing. This short-term productivity lag doesn't reflect AI's true potential. It's simply part of the integration process. Companies that invest in retraining their workforce and redesigning their workflows will eventually see substantial productivity gains. The lag is temporary. The benefits are long-term. Understanding this pattern is essential. If you judge AI's economic impact based on immediate productivity metrics, you'll miss the bigger picture. The transformative effects will unfold over years, not quarters. One of the clearest indicators that we're not in a bubble is the nature of demand for AI technologies. In the dot-com era, much of the demand was supply-driven, companies creating products and then trying to find customers. It was build it and they will come, except they often didn't. Today's AI landscape is characterized by demand pull. Organizations across industries are actively seeking AI solutions to solve real business problems. They need automation. They need better data analysis. They need to improve customer experiences. They need competitive advantages in increasingly digital markets. This isn't speculative enthusiasm. It's established industries with actual budgets and clear use cases seeking proven technologies. The demand is rooted in tangible business challenges, not hype-driven FOMO. This fundamental difference suggests a much more sustainable investment environment. If AI is a gold rush, then GPUs, graphics processing units, are the picks and shovels. But unlike speculative assets that fluctuate wildly with market sentiment, GPUs represent tangible capital investments with clear economic utility. These chips are the engines that power AI applications. They excel at the parallel processing required for training AI models and executing data-intensive tasks. As AI adoption accelerates, the demand for high-performance computing capabilities grows proportionally. Here's what makes GPUs particularly interesting. They're not just enablers of AI development. They're creating an entire ecosystem of services and solutions. Manufacturers are seeing robust demand. Cloud providers are building massive GPU clusters. Software companies are optimizing applications for GPU acceleration. The revenue potential is substantial and measurable. As AI expands into new sectors, GPU demand is expected to rise consistently. This isn't speculation, it's supply and demand fundamentals at work. And let's address the real risks. Artificial intelligence hardware is rapidly becoming obsolete. Advances in processing power and efficiency can make existing hardware obsolete in a matter of years. This is what economist Joseph Schumpeter referred to as creative destruction, in which new innovations constantly replace older technologies. For investors, this creates genuine challenges. You can't simply buy AI infrastructure and expect it to generate returns indefinitely. The pace of innovation demands agility. Companies must continuously upgrade, adapt, and evolve. But here's the crucial distinction. This is a technology risk, not a valuation risk. Technology risk is manageable through strategic planning and adaptive investment strategies. Valuation risk, the kind that causes bubbles to burst, occurs when asset prices become completely detached from underlying fundamentals. The companies leading AI development have the resources and expertise to manage technology risk. They understand the innovation cycles. They're building flexible architectures that can incorporate new capabilities as they emerge. Perhaps the most misunderstood aspect of AI's economic impact is how we measure it. Traditional productivity metrics were designed for industrial economies, not digital transformations. They capture tangible outputs, but struggle with intangible improvements. How do you quantify better decision-making? How do you measure enhanced customer experiences? How do you value entirely new markets and job categories created by AI? Current methodologies often fail to capture these nuanced contributions. During both the Industrial Revolution and the Computer Revolution, productivity metrics initially failed to reflect transformative effects. Skeptics pointed to the numbers and declared the investments wasteful. History proved them wrong. We need methodological adjustments to accurately assess AI's economic contributions. We need frameworks that account for both direct and indirect effects. We need forward-looking perspectives that recognize the substantial economic growth potential over extended periods. What would actually happen if AI were actually a bubble and the bubble burst? Let's adopt the bubble narrative for a moment. What if the skeptics are right? What if AI investments collapse? The impact would be very different from the dot-com crash. In 2000, thousands of companies with no revenue and no viable business models simply vanished. Billions in paper wealth evaporated overnight. But these were fundamentally hollow enterprises. If AI investment cooled today, the infrastructure would remain. The algorithms would still work. The established tech giants with diversified revenue streams would continue operating. AI capabilities would keep improving, just perhaps at a slower pace. Some speculative startups might fail, but the core technology isn't going anywhere. Moreover, unlike previous bubbles, AI's integration into business operations is already generating measurable value. Companies aren't waiting for future promises. They're seeing current returns. This creates a floor under the market that didn't exist in previous bubble scenarios. The narrative that AI is a bubble waiting to burst is compelling because it's familiar. We've seen this movie before. But strip away the superficial similarities, and the fundamentals tell a very different story. Profitable companies with clear business models support today's AI investments. Companies tie their spending to measurable revenue generation. The demand is driven by real business needs, not speculative enthusiasm. The infrastructure and expertise built over 2 decades have created an unprecedented foundation for rapid adoption. Are there risks? Absolutely. Technology evolves rapidly. Not every investment will pay off. Some valuations may prove optimistic. But these are the normal risks of technological progress, not the warning signs of an imminent collapse. The real question isn't whether AI is a bubble. It's whether we're prepared for the profound changes this technology will bring. Because ready or not, we're entering the deployment phase of the AI revolution, and the companies and investors who understand the structural differences between this moment and past bubbles will be the ones best positioned for the transformation ahead. The future isn't a repeat of the past. At times, the situation truly is different from previous instances. And with AI, the evidence suggests we're witnessing not a bubble, but the beginning of a fundamental shift in how we live and work, one that will unfold over years and decades, reshaping industries and creating opportunities we're only beginning to imagine. The question is not whether AI will revolutionize our economy. It's whether you'll be a part of that transformation or be left wondering what happened when you wake up 10 years later in a world that has been completely reimagined. So here's my challenge to you. If this analysis has changed your perspective on AI investments, even slightly, I'd like to hear your thoughts. Drop a comment below right now. Are we in a bubble, or are we witnessing the early stages of the most significant technological shift of our lifetime? What's your AI investment strategy? The conversation in the comments is often more valuable than the video itself, and I respond to as many as I can. If you found this deep dive worth your time, smash that like button. It tells YouTube to show this contrarian perspective to more people who are tired of the bubble hysteria echo chamber. And here's the big one. Share this video. Send it to that friend who keeps asking you about AI stocks. Post it in your investment groups. Forward it to your colleagues who are navigating AI strategy. This kind of nuanced analysis is hard to find, and someone in your network needs to see it. Finally, if you haven't subscribed yet, what are you waiting for? We're cutting through the noise every week with deep dives on AI, markets, and technology that you won't find anywhere else. Hit subscribe and turn on notifications so you don't miss the next one. I'll see you there.